It's on what type of property?
A standalone building.
Okay, so let's talk about debt and equity financing. There are two types of financing. You can do an equity financing and you can do a debt financing. Meaning, an equity financing is like you're offering part of your business, part of your company, and part of the deal, if you will. So you're gonna pay some cash flow to the investors coming in, giving you money as equity, and then you're gonna give them actually an upside. These people that come in and put money for equity deal, they're like partners. In a fund, they're silent partners, they're limited partners, and you're the general partner. In an equity deal, they can lose money also. And there are two types of equity financing. There is what's called the private equity financing, which is the private placement memorandum that we do. We can help you with that if that's what you want to do. Or there is not the private, but the public offering. The public offering is like, you have a company, you're going to issue some shares, and people are going to buy the shares. They may have a dividend, and then the shares price go up as the company improves. It's an interesting way to finance. People get interested in it because they feel like they can make some extra money on the upside. Well, let's talk about now debt financing. Debt financing is literally borrowing money. So you're going to borrow, you pay an interest rate of return. And instead of equity financing where you pay some dividend and an upside, in a debt, you just pay a flat interest rate of return. The upside is yours. You don't share it with others. So like I gave the example, in a public offering, they sell shares or stocks in the stock market. In debt financing, they sell bonds, or also it's called debentures. Debentures are, these are notes secured by companies that are not publicly traded, etc. So the combination, Alan is asking for the combination. The combination is you get some of each. So for example, you can do, I'm going to offer you some shares with an upside, but you have to put so much money in the deal. So let's say no less than 100,000 a share, and then we're going to pay you 5%. And then from the upside, we're going to give you 60 or 70% of the gain on the property. And you can put another class of shares. You say, these are just flat returns. These are just debt shares. We're going to pay you, let's say 7% only. And that's what you're going to get. So instead of getting 5 on an upside, you can get 7 from the get-go, and you can start with 25,000 increments. And the best way really, in my opinion, is to do debt financing. You set up a real estate fund with debt offering. This is what we do. This is what I've done. We have a lot of people set up. We do it turnkey for you. You set up a debt fund and you tell people, I'm going to offer you, you can invest as little as, let's say 25,000. I'll offer you 6%, 8%. And 8% is if you put 250,000 plus, people will give you the money. Then you can get a loan on the property, and you're able to now put some of your money to rehab it, some of your money as reserves. And that combination between debt financing and a bank financing will give you the best potential cash flow and the biggest upside for yourself. It can transform your life. There's just no doubt.